Stellar Diamonds was by far and away the top riser in London this week after the junior miner told investors it is in advanced negotiations over a possible takeover offer from Newfield Resources. AIM-listed Stellar said the possible bid, as it currently stands, would see each shareholder receive approximately 0.76 of a Newfield share for each Stellar share held. Given Aussie-quoted Newfield stock closed at 8.29 cents on Wednesday, the offer would represent a whopping of 452% premium to Stellar's closing price of 2.3p the day before the bid. The offer is conditional on Newfield securing underwriting for a $30 million rights issue, the funds from which would be used to advance Stellar's Tongo Tanguma project in Sierra Leone into production. Stellar wheeled out the usual "there can be no certainty of any offer" line, but investors still poured in. Shares surged 150% to 5.75p across the week. It can sometimes be tricky, to put it politely, for foreign companies operating in Russia to get a mining license for their projects in the country. There is a whole host of governmental bodies involved in the process, and it can be a laborious and time-consuming maze to navigate. Eurasia Mining is faring far better than most, though. The junior miner, which, importantly, has experience of successfully gaining a mining permit in Putin's playground, is well on its way to securing another, this time for its Montacundra project on the Kola Peninsula, which is estimated to be host to 2 million ounces of palladium equivalent. That has now been forwarded on to the Ministry of Defense and Federal Security Service to get their go-aheads. The market cheered the quick progress, with shares up more than a quarter to 0.37p. Given all of the column inches devoted to data hacks recently, Yahoo, Equifax and the WannaCry bug that brought down the NHS, you'd think cybersecurity companies would be coining it. Not at Definx.The company, which has offices in London, Switzerland and Rome, plummeted back in October when it said revenues for the year to December 31 would be materially below those generated in prior year, and that it would record a significant full-year loss. That warning was due to delays to a few high-value contracts, while the delivery of product updates to address certain performance issues also took longer than expected. On top of that, several customers owe it money, and Definx said on Monday that it has struggled to recoup what it is owed over the past 2 months or so, despite going down the legal route on some occasions. Should this cash collection remain weak and new orders fail to materialize, the firm won't be able to draw down any of the funds from its various debt facilities, and thus may be required to seek additional funding in the next quarter. That sparked a bit of a sell-off, with shares plunging 23% to 18.1p. Although a slight rally on Friday helped to pare the weekly losses to 7%, with the stock changing hands for 22p. One of those holding the junior market back was ImageScan Holdings, which saw more than a third wiped from its value. The X-ray screening systems supplier told investors only in December that it had started its new year with a record order book, although it did note that delivery dates for some of those had yet to be confirmed. Well, one of those deliveries still hasn't been confirmed by the customer, so ImageScan is now negotiating terms for the cancellation of the order. Unfortunately for the company and its shareholders, that deal was worth around £1 million, an awful lot of money for a company now valued at just over £5 million. As a result, bosses said its results for the current year would fall materially below current market expectations. While bosses reckon they'll still be able to sell the portable X-ray products that made up the order, they're not convinced they can do this in the current year. The shares plunged 38% to 4.4p. January is rarely a good month for alcohol companies, what with dry Jan and empty wallets after Christmas. Bargain booze owner Conviviality reported its interim results at the end of the month, and margin pressure had the share price going down swifter than a can of special brew. Results were mixed, with the wholesaler, an off-license stores operator, reporting a 9.2% year-on-year increase in revenue to £836.3 million, and a 1.7% increase to £23.2 million in adjusted underlying earnings, EBITDA. But the gross margin ebbed to 12.5% from 12.8% due to an increase in sales to large national account customers in the period, leading to a 1.6% fall in pre-tax profits, which came in at £12.3 million.